So I was looking at the Harvard University endowment filings this morning. And usually, digging through institutional disclosures is about as exciting as watching paint dry.
Right. It's not exactly thrilling stuff.
Not at all. You expect treasury bonds, some blue chip stocks, maybe Timberland if they're feeling a little spicy. But then I saw this one line item and actually had to double check the date. I thought I was reading a Reddit thread by mistake.
I know the feeling. What was it?
Because Harvard isn't just holding crypto anymore. They are actively trading it.
Yeah.
And the way they're trading it suggests the entire institutional playbook has just been rewritten.
It is a massive signal, isn't it? We're looking at a market report here dated February 17, 2026. And honestly, the headline numbers, Bitcoin at 68,000, Ethereum near 2,000, they're the least interesting part of this whole story.
Exactly.
The real story is buried right there in that Harvard filing. It tells us that the set it and forget it phase of institutional crypto adoption is, it's officially over.
That's exactly what we need to unpack today. We've got a whole stack of reports covering this Harvard move, some absolutely wild usage stats from the TRON network, and this global race for regulation from Hong Kong to Dubai.
So our mission today is to figure out why the smart money is suddenly moving around, what the heck a real-world asset is, and, more importantly, why it seems to be the only sector growing while everything else is bleeding.
And we have to start with the context of where we are right now, mid-February 2026. If you just look at the price charts, it looks like a disaster.
It really does. The report calls it an adjustment phase.
Adjustment phase. That feels like a very, very polite euphemism. Let's look at the numbers. Bitcoin's trading around $68,851. But the report notes that the peak of this cycle, which wasn't that long ago, was 126,000. That is a drop of nearly 50%. I mean, if my 401k dropped 50% in a few months, I wouldn't call it an adjustment. I'd call it a catastrophe, and I'd probably be firing my financial advisor.
And that's a totally fair reaction for a traditional investor. But you have to look at the historical cycles in crypto. A 40 to 50% drawdown after a parabolic run-up to a new all-time high, in this case, that 126K mark, is, it's historically consistent. It's just the market digesting the gains.
Okay.
And the report highlights that inflows into ETFs, the exchange-traded funds that let you buy crypto on the stock market, they've slowed down significantly. The initial rush has cooled off.
Okay, so the tourists have gone home, the hype has died down. But that makes the Harvard move even weirder. If the market is adjusting, you'd expect a conservative behemoth, like the Harvard Endowment, with almost $57 billion, to run for the hills.
Or at least hunker down in Bitcoin.
Exactly, the safe asset. But they didn't do that.
No, they did something much more sophisticated. Let's look at the specific trade. Harvard reduced their Bitcoin ETF position by 21%. They went from holding about $442 million down to $265 million.
So they took about $177 million off the table, which in isolation looks like a huge sell signal. It looks like they're losing faith.
Right. If you start reading there, yes. But they didn't take that money and just put it into cash. They rotated it. They opened a brand new position worth $87 million in BlackRock's Ethereum ETF.
This is the part that just blows my mind. For the last 5 years, the whole institutional narrative has been Bitcoin, not crypto. Bitcoin is digital gold. It's a store of value. It's serious. Everything else, especially Ethereum, was seen as, a risky tech stock.
Or an unregistered security, yeah.
Right. So Harvard buying Ethereum feels like conservative grandpa suddenly buying a stake in a Silicon Valley startup. Why make that switch? What does Ethereum offer an endowment that Bitcoin doesn't?
That is the critical question. I mean, think about what an endowment needs. They need growth, sure, but they're also hunting for yield and utility. Bitcoin is a sterile asset. It just sits there. Its value comes from scarcity, like a bar of gold in a vault. It doesn't generate revenue unless you sell it.
So it's a pet rock, a very expensive digital pet rock.
A bit harsh, but functionally true, yeah, regarding cash flow. Ethereum, on the other hand, is a productive asset. It's a network. It generates fees. It's the infrastructure that other applications run on. By rotating into Ethereum, Harvard is basically betting that the future of finance isn't just about holding money. It's about moving money and running programs on top of money.
So if Bitcoin is digital gold, they're realizing they also need to own the digital.
The digital oil. the fuel that powers the machine. It's the perfect analogy.
And it's about diversification.
Exactly. Diversification is the only free lunch in finance. If you hold 400 million in Bitcoin, you're purely betting on that store of value idea. By moving 87 million into Ethereum, you're hedging your bet. You're saying, we believe in the asset class, but we don't know if the winner will be the gold or the oil, so we're going to own a bit of both.
It signals the death of Bitcoin maximalism at the institutional level, doesn't it? If the smartest, most risk-averse money in the room says a portfolio is incomplete without Ethereum, that debate is, it feels like it's over.
I think you're right. It validates Ethereum as an institutional-grade asset class. It's not just an experiment anymore.
Okay, speaking of experiments and things running on networks, let's pivot from the ivory towers to the muddy trenches.
Yeah.
Because while Harvard is rebalancing spreadsheets, there is some absolutely crazy activity happening on-chain. I was reading the Q4 2025 report for the TRON network.
TRON.
And the numbers made me do a double take.
TRON is fascinating because it's the network that everyone in the West loves to hate or at least ignore, while the rest of the world just uses it.
Well, uses it is an understatement. The report says TRON had 20 million daily active addresses in the fourth quarter, and they processed 994 million transactions.
Almost a billion.
Almost a billion transactions in 3 months. That's a 16% increase from the quarter before. Now, I have to play skeptic here. Are these just bots trading meme coins back and forth? Because 20 million people is a decent-sized country.
And that's the common misconception. The data shows this activity isn't driven by speculation or memes. It's driven by stablecoins.
Okay, so let's clarify that for everyone listening. Stablecoins are crypto tokens pegged one-to-one with a fiat currency, usually the US dollar. So it's basically digital cash.
Exactly. And the reason TRON is exploding is because it's cheap and it's fast. If you're a freelance developer in Nigeria or a merchant in Argentina, you don't care about decentralization philosophy. You just want to pay a supplier in China $500 without losing $50 to wire fees and waiting 3 days for Swift to clear it.
So TRON has become the de facto payment rail for the developing world. While Wall Street is debating Bitcoin versus Ethereum, the rest of the world is just using TRON to move dollars around.
Precisely. It's the utility over hype argument in action. Even though the price of a lot of speculative assets is way down, the actual usage of the network for real economic activity for payments is at an all-time high. That 994 million transaction figure is proof that crypto has found product market fit.
It just doesn't look like what the Silicon Valley venture capitalists thought it would.
Nope. It looks like a digital Western Union.
That brings us to a term that keeps popping up in these reports, and it really connects the Harvard strategy with this whole utility story. RWA, real-world assets.
Yes.
The report notes that while the broader crypto market, the fun stuff, dropped by $1 trillion recently, the sector for tokenized real-world assets actually grew by 13.5%. That is a massive decoupling.
It's the most important trend in this cycle. I really believe that.
But let's break it down, because real-world assets just sounds like buzzword soup. What are we actually talking about here?
Yeah, it does. But think of it as wrapping a physical object in a digital container. Let's say you take a U.S. Treasury bond. Traditionally, that bond sits in a ledger at a bank.
Right.
Tokenization just means you create a digital token on a blockchain, like Ethereum, that represents ownership of that bond. If you hold the token, you get the yield from the bond.
Okay, but why bother? I can just buy a bond from my broker? Why do I need it on the blockchain?
2 words: liquidity and speed. If you want to sell your traditional bond, it can take days to settle. If it's a token, you can sell it 24/7, instantly, anywhere in the world. But the reason we're seeing this 13.5% growth right now, while the market is down, is safety.
So it's a flight to quality.
Exactly. Investors are scared. They don't want to hold volatile crypto tokens that might drop 50%, but they also don't want to leave the crypto ecosystem entirely because moving back to fiat is slow and it's tax inefficient.
So they park their money in tokenized treasury bills or tokenized gold.
That's it. They get the safety of a government bond, but they stay on the blockchain, ready to deploy that capital when the market turns.
That makes perfect sense. The casino money is leaving, but the savings account money is growing. It really does feel like the market is maturing. It's not just about gambling anymore. It's about preserving wealth.
And that maturation is, of course, attracting the regulators. This is the third pillar of our deep dive today. We are seeing a global race to regulate this stuff, and the strategies are wildly different depending on where you look.
It really feels like a tale of two hemispheres. On one side, you've got Asia, specifically Hong Kong, basically kicking the door open. On the other side, the U.S. is, it's complicated.
Yeah, that's one way to put it.
Let's start with Hong Kong. The report mentions the SFC, their regulator, granted a license to a company called Victory FinTech.
Which is a big deal because it's the first license they've granted since June of 2025. There was this long pause where everyone thought maybe Hong Kong was getting cold feet. This license signals that the pause was just them tightening the rules, and now they are open for business again.
But the real game changer is what's coming next.
Yes, they're preparing a framework for perpetual contracts.
Whoa, hold on. Perpetual contracts are the high-octane fuel of crypto trading. They're futures contracts that never expire, letting traders bet on prices with massive leverage. For a regulator to say, yes, we will regulate this gambling tool, instead of just banning it, that is aggressive.
It is incredibly aggressive. It shows Hong Kong understands that if you ban the popular products, the volume just goes offshore to shady, unregulated exchanges. By regulating perpetuals, they're trying to capture that revenue and bring it under a legal umbrella. They want to be the liquidity hub of Asia.
And then you compare that to the U.S. We do have some good news. Nexo is coming back.
Right. Nexo had to leave the U.S. market 3 years ago because regulators basically chased them out with pitchforks. Now they're returning through a partnership with Bakkt. It signals a thaw.
A thaw. I like that.
It shows that if you play by the rules and partner with established players, you can operate in the U.S.
But then you have the bad news, or at least the confusing news. The report mentions Paradigm. A huge investment firm is fighting with policymakers about crypto mining.
And this is the ongoing friction in the West. The U.S. is still debating the very existence of the industry in some ways. Paradigm is having to argue that crypto mining helps stabilize the energy grid, which, true, by the way, but the fact they're still having this debate shows how far behind the U.S. is.
It's just weird, right? In Hong Kong, the government is saying, here is exactly how you sell complex derivatives.
Yeah.
And in the U.S., the government is saying, wait, are you allowed to plug a computer into the wall?
That uncertainty is why you see companies like Animoca Brands getting licenses in Dubai and OKX getting licensed in Europe. Capital goes where it's treated best. And right now, the regulatory clarity is in the East.
And yet, despite all the confusion, the builders keep building. I saw a note about Zircuit Finance launching something called Vaults on February 17th. This is a Layer 2 project.
A fast lane built on top of the slow Ethereum highway, essentially.
Exactly. And the fact that Zircuit is launching a new product in the middle of a market correction, this adjustment phase, is just a reminder that technology cycles don't care about price cycles. Engineers are still writing code. The vaults are alpha testing for early adopters. It's real innovation happening while everyone else just stares at the Bitcoin chart.
That's right.
So let's try to synthesize all of this. We've got the Harvard pivot, the explosion of utility on TRON, the rise of safe haven real-world assets, and this geopolitical chess match over regulation. If you step back and look at the whole board, what's the story of February 2026?
I see a pincer movement.
A pincer movement. Explain.
Yes. From the top down, you have institutions like Harvard normalizing the asset class. They're moving past the, Bitcoin dipto phase and building sophisticated multi-asset portfolios. That provides the capital floor.
Right.
Then from the bottom up, you have the developing world using networks like TRON for actual payments. Not speculation, but survival. That provides the usage floor.
And wrapping around both of them is this new regulatory framework.
Exactly. The regulations, whether it's Hong Kong's licenses or the U.S. thaw, are building the guardrails that allow the top-down money and the bottom-up users to meet in the middle safely. We're watching the transition from a Wild West gold rush to a civilized modern economy.
Which brings us back to the listener. If the market is professionalizing, what does that mean for you, the individual investor? The report had some specific advice, didn't it?
It did. The primary warning was don't FOMO.
Fear of missing out.
Right. When you see Harvard buying or you see a price jump, the impulse is to just throw money at it. But the report really emphasizes due diligence. Understand what you are buying. Are you buying a meme coin with zero utility or a piece of infrastructure like Ethereum?
Are you buying a speculative token or a tokenized real-world asset with an actual yield?
That's the question. The era of buy anything and get rich is over. The era of invest in value has begun.
I want to leave everyone with a final thought to chew on based on that Harvard move. We spent years hearing that Bitcoin is the only institutional asset. The maximalists told us that institutions would never touch Ethereum. It was too risky, too complex, whatever. But here we are. Harvard sold the king of crypto to buy the world computer.
It definitely changes the conversation.
So does this mean the future of finance is inevitably multi-chain? Is the idea of a Bitcoin standard dead, replaced by a diverse economy of different tokens for different jobs? If Harvard thinks so, I wouldn't bet against them.
It's the multi-billion-dollar question, isn't it?
Thanks for diving deep with us today. Keep your eyes on the filings, not just the charts. We'll see you next time.
Goodbye, everyone.